Now, if you can meet those conditions, then you can get that final loan approval and proceed to a closing. But if you can't meet those conditions, that means you don't get loan approval. So you want to be very, very quick, accurate, and detailed in getting them every single thing that they are asking for, and be very cooperative. If you're looking to be a homeowner, you're probably wondering what the steps are that go into the process. So that's what we're going to talk about today. And what I'm going to assume is that you have a house already under contract, because there are some additional steps if you go through the process where you do a pre-approval and then you go ahead and get a house under contract. So for this video, we're going to assume that you've got a house under contract, and we're going to talk about everything you can expect so we can put your mind at ease. If you're new to the channel, please be sure to subscribe. Don't forget to hit the like button if you're enjoying the content, and hit the bell to be notified every time I drop new videos, which is every single week, about anything and everything mortgage education. My name is Stephanie, and I've been a loan officer for over 18 years, helping thousands of people with their mortgage process. And I love it, and I love teaching about it. And if you're going to be financing in Louisiana, Mississippi, Alabama, or Florida, my team would love to help you. Give us a call, shoot us a text, or send us an email. Okay, so you've got your home under contract, which means that you and the seller have agreed to what you're going to buy and what they're going to sell, and you've come to an agreement on that. So the next thing, if that's the first thing you've done, is you're going to do your loan application. You're going to want that to be very, very detailed and very, very accurate. That's something that's typically done online. It's a government form that's created, so it's a standard form for everybody to complete, and it asks you things like full legal name, date of birth, where you've lived for 2 years, where you've worked for 2 years, how are you paid, how is it broken down, what are your other sources of income, if any, what do your assets look like, such as checking, savings, stocks, bonds, CDs, things like that. There's a declaration section that asks about bankruptcies and foreclosures and judgments and things like that. You want to go through and make sure that it's very, very detailed. The next step is going through the processing phase, where the processor is going to do things like order appraisal, order the title work, ask you for potential additional documents, because a lot of times it might take you a little bit to find a house. And so the documents you produced might now be outdated, like the bank statements or the paycheck stubs. So the processor might need to get some updated paperwork, order the title, order the appraisal, or the evidence of insurance, and start packaging the loan for the next step. Step number 3 is going to actually be that appraisal. Now, don't be confused. The appraiser is not the home inspector. Most loans do not require a home inspection, but I 100% of the time suggest that everyone get a home inspection. I think it's imperative. What the appraiser's doing is looking at the condition of the home, looking at homes that have sold in the comparable area, in the comparable range, to make sure that there's a market value or sales comparison approach value that's given. It's then supported by at least 3 comparables that are similar in likeliness and similar in size and things like that. They're not necessarily going to inspect the property as detailed as an inspector may. Now, VA inspects the property the most when it comes to an appraisal. Then when it comes to FHA and RD, it's inspected a little bit less, not quite as much as VA. But when it comes to conventional, that's typically the lesser of the inspection. Now, again, don't confuse this with a home inspection. We're talking about the appraisal at this point. Now, once that appraisal comes in, it leads us to one of the next steps where the underwriter is going to be looking at the file. The underwriter wants to make sure that you have the credit that's acceptable, that you have the capacity to repay, which is why they're going to ask you for all those documents, and they're going to verify things with your bank, and verify things with your employer. They're going to make sure that that collateral is acceptable, meaning the property itself is in acceptable condition. Is the appraisal strong? Is the value supported? Now, once the underwriter looks at this file, they're going to issue what's typically called a conditional approval. When the underwriter underwrites the file, we typically don't have the title work back yet. We typically don't have the proof of insurance back yet. And those are some of the things that are going to be on that conditional approval. Some other things might be like requesting an additional comparable from the appraisal, or maybe the appraiser left off a picture that needs to be added. Maybe the appraisal said drive when it really should be street, so they want to make sure which one of those is actually correct and make sure that title, loan application, appraisal, and so on, insurance, all match that street versus that drive. They might ask for a driver's license, maybe because yours expired. They might ask you about deposits that maybe the processor or loan officer missed, but deposits that went into your bank account that need to be questioned, sourced, or seasoned. And a number of other things as well. Now, if you can meet those conditions, then you can get that final loan approval and proceed to a closing. But if you can't meet those conditions, that means you don't get loan approval. So you want to be very, very quick, accurate, and detailed in getting them every single thing that they are asking for and be very cooperative. The next item is going to be the next step, shall I say, is going to be your closing disclosure. That goes through all of the numbers, and it's something for you to review, and you have to have it a certain period of time before you're closing. It's going to show things like your name, the full address of the property with that street or that drive like we talked about before. It's going to list all the numbers, the sales price, the down payment, any credits that you're getting from the seller, credits from the lender, or credits from any kind of deposits that you gave. It's going to give you lump sums of these figures and then give you the bottom line cash to close figure. Cash to close is down payment, if any, plus closing cost plus prepaids. And then it's going to break down to the penny in detail, line item by line item, what those totals are made of. And it's still an estimate for you when you get it, but it's the closest estimate to what they think all the numbers are coming together to be, so that you can prepare for closing, bring your certified check, and know how much money to bring to that closing table. We're down to the last two steps. Now, what that is the words that every loan officer, the next step is the words that every loan officer loves to hear. It's like music to our ears, and that's called the clear to close. Remember, the underwriter issued that conditional loan approval? Well, the processor works along with you, the insurance company, the title company, the appraiser, the clerk of court, whatever applies, to meet all those conditions and send them back to the underwriter, who then reviews the file and hopefully issues you the clear to close. That means that everything's good, you're ready to show up for closing. Don't do anything crazy. Don't go finance anything. Don't go buy anything. Don't go spend your money. Still be frozen in time there. But that clear to close is like, oh my gosh, okay, we've made it. It's good, we're all ready for closing. It's very exciting, which leads to the final step, which is your closing and your loan funding. That's where the lender actually brings the money to the table. The title company divvies up the money to everywhere it goes. Like, there's going to be money that goes into escrow. There's going to be money that might go to the tax assessor, money to the insurance company, money to the title company, commissions to, well, no, that's the seller side. And all those different, like money to the appraiser if you haven't prepaid for your appraisal. They kind of divvy up where all the money goes. Now, once you've gotten to closing and you've gotten that loan funding, you are officially a homeowner. How exciting is that? Thank you so much for tuning in to today's video. I really hope that you enjoyed it as much as I enjoyed putting it together for you, and I look forward to seeing you in the next one.